Watch with Peak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My name is Anton Madley, co-founder and CEO of Peak Financing. And my co-host today is John Martinez, one of our great senior debt advisors at Peak Financing. We are honored to welcome Mark Allen, Executive Managing Director with Greystone Investment Sales Group. Welcome, Mark. It's a pleasure to have you with us today.
Thanks, Anton. Yeah, excited to be here, and thanks for having me.
Yeah, so why don't you give us a brief background about you? Obviously, you have a very interesting career, right? From a young age, right out of school. You're a West Point graduate, so thanks for your service, right? So that's I would say it's always important, but I think as we all know it's not that easy to get into West Point, and I'm sure it's not that easy to get through those years and graduate from there. So congrats on that. So why don't you give us a little bit of a background?
Yeah, so they said if I can make it through West Point, although there's going to be ups and downs, but the rest of life should be, relatively easy. So I went to West Point. I played football in college, and that was kind of, honestly, it was my main driver. Although there was a service to the country aspect, there was an aspect that it was something a little bit different than what the rest of my peers were doing. So that, that was enticing to me at the time. And, at 18, you really don't know what you want to do. So I was kind of figuring things out, but, thankful that I landed there, just off the Hudson River, north of New York City at West Point, and graduated, was in the Army for some time, but I started my real estate, I don't know if you want to call it career, but I bought my first property my junior year in college at West Point. They give us a career starter loan, knowing that you're going to come out, you have a guaranteed job, and you're going to pay back. That debt or that career starter loan through your military paycheck. So I got a $35,000 loan at a 0.5% interest, and it was prime time to buy real estate at the depth of the Great Recession in 2009, 2010. I ended up buying a foreclosed condo for $20,000 in Florida, 2-bed, 2-bath, about 4 miles from the coast. That kind of got me going, and I said, hey, this cash flow thing is cool, and started to dive in. When I got into the military, I was a little more active doing single family fix and flips and mortgage wraps and a bunch of creative strategies, anything I could do with living kind of a little side hustle with military pay. And then, that led me to want to do, bigger and larger deals, which caught my, the multifamily industry caught my interest, in about 2000, maybe into 14, early 15. And then I started to get networked in once I moved to Dallas. And long story short, here I am today with Greystone, as an investment sales broker.
Yeah, great story. What you mentioned, right, that you were able to get that loan, I think that's a good message to all the other service members, right? So some of them, or whatever free cash flow they have, they put into toys, right? And you did the right thing. I think there are so many opportunities for service members, right, to really take advantage of where they are in life and buy investment properties. So you did that, and so that's great to hear. And obviously you got that investment back from early on, and that certainly has helped you in your career. So congrats to that. Now, obviously, even though you had that initial interest, getting into investment sales is not that easy. So I think you were also very, very hard charging early on with in your career, and that was really helping you to get to the position where you're in today. Now, what we would like to do is you are in Dallas Fort Worth. Obviously, you know the whole market, but I think you have certainly a very strong knowledge, particularly Fort Worth and the mid cities. So maybe we can touch a little bit on that and go a little bit deeper. What you see in that market today with COVID-19, everyone was scared to death when March 2020 hit, and when for a brief period financing dried up, other than the agency financing, and a lot of people thought, oh, now we are really in a massive amount of trouble going forward. And obviously that was just a very brief period, and since then everything moved up. So how did you experience that as on the sales broker side, that period, and how quickly did you realize that, oh, this is just a brief period of concern and that things go back up?
No, I mean, there was a lot of uncertainty. I think, brokers were no different. Where I think, I guess maybe taking a step back. So I'm with Greystone Investment Sales Group, and we have a team of, I think, 12 brokers right now, but we're bifurcated into teams. So, we've got a secondary markets team, what we call a small balance team, which would really be kind of 49 units and under. And then, I lead our DFW workforce housing team. So, we've got a larger team when you look at some of the other, brokerages across the Dallas-Fort Worth Metroplex. And we'd come together, through that time, through the end of March, April, and even May. We'd meet, 3 times a week, and there was a lot of uncertainty, and we were trying to stay. We made a commitment during that time where we thought, and what we heard, a lot of our competition, took it as kind of a vacation time to go out to, lake houses or whatever, and just kind of enjoy the spring weather. Because the market was dead for the most part, but we try to take advantage and try to update those in the market that own multifamily on best practices and the challenges, understand the challenges they were facing, solutions or creative options that they were implementing operationally to help. And so we really took the time to make a lot of phone calls and just try to get educated and just pass on best practices. And honestly, we had one of our better years last year, and I think part of it was not vacationing during Q2 and stay in place in the pandemic. And I think ultimately it really paid off to, just help our clients out in general, and ultimately lead to, helping out on the sales side.
Yeah, that's great. Great to hear. Have you seen a lot of buyers walking away from deals during that period?
I think at the time we had 13 deals under contract. We ended up losing 3. And, I had one in particular that I lost, and it was a private syndicator, local syndicator, who just didn't think he could raise the money because there was so much uncertainty. And that deal is actually about to come back to market about, I'm going to say 15,000 a unit higher. It was a property in Waco. So we're about to bring that back out to market. But I mean, if you think about it, I mean, it was a great buy then. I think it was on an assumption, and it was over a 7 cap at the time. And it's just, north of a 7 cap is unheard of with interest rates around, 3% today. But we had 3 properties fall out of escrow. And I think all of those, for the most part, were just those that were either, fearful, scared of what's to come, didn't want to ride through the uncertainty, or 2, they would have purchased the property. They just didn't feel like they could raise the equity.
Yeah. Right, John, we have seen a number of situations back then. Obviously, borrowers were pretty scared. Message from some of the lenders also was, sorry, we need to take a break On the agency side, it wasn't such an issue, but solely on the bridge side, a lot of bridge lenders virtually stopped overnight. So it's understandable, right, when you have a lot of equity at stake and hard money at stake, that you get scared, right?
Yeah, it ends up being what you see, I think, in many crises, Antons, is, um, solvency may not be your issue. Oftentimes you have to solve for liquidity, and some of these deals had varying success finding liquidity, but it's great to hear that most of your deals were able to close their mark.
Yeah. And for us, I think it was our mentality was, hey, we're going to come into the office every day, and we're going to try to put a deal together, pass on valuable information, or save a deal from falling apart for those 2 months. And we have a lot of young brokers that have been in the market for less than 10 years. And many of those under 5 years. But Todd Franks is my business partner, and has 22 years of experience. So he went through the Great Recession, and had some valuable insight, and we were able to get creative on a handful of deals and keep those together. So
yeah, that's great to hear. So now running it forward to today, I'm sure that that prospective buyer who walked away is now sorry that they didn't pick it up at that point, right? But hindsight is always 2020, right?
Sure.
So that's just a reality. So how do you see the market today from a seller's perspective as well as buyer perspective? What are sellers and buyers telling you when you talk to them?
So the market is just on fire right now, both, operational perspective and sales velocity and volume in Dallas Fort Worth is, unparalleled across the country. Rent growth, I think we actually lag. According to Yardi, we're roughly about 46 out of, I think, almost 100 markets. And we're, at least according to CoStar, we're roughly about 13% rent growth. So that tells you, rents across the country are just booming. I was on an NMHC panel yesterday with the Morgans were on there, who, I think they own and operate, getting pretty close. I want to say there were 80,000 units, but, he said in his 40-year career, he's never seen lease trade outs and the revenue growth on renewals and new leases, where it's at today. So from a seller perspective, you got a couple of different challenges. There's obviously some tailwinds behind you with rent growth, but challenges are, the big topic the last couple of months are the Biden administration tax changes. So, increased capital gains. There's been talk of the 1031 exchanges going away. So I think the expectation is taxes are going up. It's a question of how much are they going to go up. And, I think with, that coupled with, really strong pricing right now, as far as price appreciation, cap rate compression, which are really frankly due to low interest rates, historically low at, like I said, around, I would say they range, and you would know better than I, but 2.5% all the way to, maybe 4, on, more of a traditional loan, whether it's HUD financing, agency, or bridge. So record low interest rates, incredible rent growth, and then, just an insane amount of liquidity that's been sitting on the sidelines. A lot of people need to put money to work. So with those forces, prices are going up. And I would say in Dallas Fort Worth, year over year, we're probably seeing 15 to 20%, price appreciation, which is just crazy. So, you got the price increases, and then you kind of have potential tax changes on the horizon. So I think there's a lot of owners that, haven't been thinking about selling for a long time, and are now starting to consider, or definitely changing their mind. So we're seeing, a lot of sellers in today's market. It's a true seller's market. From a buyer's perspective, it's very competitive in Dallas Fort Worth, and probably even the surrounding secondary markets too. Speaking to our secondary markets team, the terms are, as aggressive as ever, from a buyer perspective, and they're seeing more bids and more tour activity. on those secondary markets deal, some of the smaller markets in Texas. But in the same respect for buyers, I think we see a little bit of buyer fatigue. At the end of the year, it's just prices are going up. They're spending a lot of time. They're getting outbid on properties. The off market deals, which it's still a big part of our market. I don't know the percentage, but here at our shop, probably half of our deals are off market. So still a lot of off market inventory happening. So those that are missing out on marketed and off market deals, it's just, spending a lot of time, and it's frustrating to get outbid in those scenarios. And there's been a lot of inventory on market. Frankly, as a broker here, we've seen less over the last really 2 months. And it really started to happen over the summer. And I thought it was just because, summer travel, people are vaccinated. And I think that was a little bit of an aspect, but talking to my competitors as well, it's been tough to get buyers focused on deals because a little bit of buyer fatigue, but also just the amount of inventory on the market. So, whereas it really depends on the asset, like, an 80s vintage asset that has been held for 20 years and is, 200 units is going to see a heck of a lot more tours than a 1970 chiller boiler property and a C location that is traded 3 times a cycle. So, it's all about, I think, the deal story and how the asset's priced too, as far as how much attention it's going to get. But, I'd say our tours and offers have probably decreased, I'm going to say 30-40% in the past couple of months. So it's a challenging time. It's a good time to be an investment sales broker, but at the same time, it's challenging depending on the deal.
Yeah, that's very interesting that you see that buyer fatigue. Obviously, from our side, we work with a lot of various buyers, from syndicators to private buyers, and we only see the frustration on a daily basis, right? So there are strong teams that they have enough cash that they can put in for earnest money. They are willing to close fast, and they're willing to underwrite aggressively, but they are usually still being outbid, right? So that at some point, that frustration turns it into a buyer fatigue. So it will be interesting to see how it evolves over the next few months and how we enter into 2022. So how do you see how that is going to evolve? Again, also, obviously, we do not know where the taxes ultimately will end up, right? I think, as you said, we can all agree that they will go up in one form or another. How exactly real estate investors will be affected still remains to be seen to the full extent of it. But how do you see how it will impact the sales side and the seller positioning, and how buyers will react next year?
I think, what we're seeing at the end of this year is probably going to be pretty similar into next year. I think the expectation for most is interest rates are going to stay low. Rent growth is going to continue. And like I said, I mean, we're at 13% year over year. I think, if you look back 4 months ago, we were at roughly, 3-4 months ago, 10%. So, we may even see in Dallas Fort Worth a little bit higher rent growth through the end of the year, although, coming up on the holidays. But, rent growth will be strong next year. So I think it'll continue to be a seller's market. There'll be a lot of sales activity. From a buyer perspective, at the end of this year, a lot more people are asking, hey, are the sellers open to a preemptive offer? There's some buyers that are just, like I said, the buyer fatigue. They're not. They're being much more selective on where they spend their time. And I think some of the more sophisticated buyers are really trying to spend their time on, preemptive offers if the seller is willing to engage, and then, off-market deals. So I think we'll see probably a little bit more of that as well.
that's a good point. And that really points towards the expertise that is required by buyers, right? With preemptive offers, you know your market, you know the property already. You may not have toured it, but you know the submarket really well. So you can make up your mind well ahead of time, which obviously helps you to come in with that preemptive offer approach. And I think it makes sense, right, for someone who has a high level of expertise in a particular submarket.
Yeah, and from a broker's perspective, I mean, there's a lot of different buyers who, ask, "Hey, is the seller willing or open to a preemptive offer?" And that really just depends, because at the end of the day, it's we're all about probability of closing. It's our reputation on the line. So if it is a preemptive offer and the seller's open to that, it's going to be someone that has a lot of experiences. Is a sure deal. And the other big thing is obviously price. Can they get to the price, and are the terms market terms or strong terms? So
yeah, makes sense. Now, what we see on our end, on the financing side, a lot of buyers obviously see a challenge getting, even for stabilized properties, getting the leverage that they need. Right, John, we see that essentially with every single deal, right? When we look back a few years, particularly with Fannie loans, it was normal to get 80% financing plus the rehab plus closing cost baked in. And today, one can be lucky in DFW for a stabilized asset to get to 70% of leverage.
Yeah.
So have you seen that with your clients too? And what approach are they taking to take down these deals despite that challenge?
Yeah, I think we have. I want to relook at the data. I know this summer we had 17 escrows back in like July timeframe. So 17 properties under contract, and 2 of them were under contract with agency debt. The rest bridge, and that's just because the DSCR challenges, and one of them was in Dallas Fort Worth, the other one was in a secondary market in Wichita Falls, North Texas, far North Texas. And the one that was in Dallas Fort Worth was a buyer willing to accept just lower leverage. I think it was 66% LTV. It was a Freddie floater, and they wanted to take I guess the short term debt risk off the table. They bought caps, interest rate caps, and so anyways, that's probably very similar to what you're seeing. I think that's what I'm hearing really across the nation, speaking with some of our investment sales teams in Atlanta or other markets like Houston. So
yeah, same here, right? So the advantage of all this with all these bridge loans is obviously either to go into a permanent financing 2 to 3 years from now, or if the market is doing really well, then you get another round to sell the same property again, right? So for you guys, it's potentially is a providing additional tailwind to your sales activities, right?
Right.
Yeah.
I don't think either of us on the transactional side are complaining, but yeah, and I mean, and a lot of these deals are, some of the deals I don't even think are really bridge deals, but they're going bridge. And I think there's been so much bridge loan activity, and just hearing from recently in the past 2 weeks, hearing from some of the active buyers, and I'd be interested to hear your take on this, but I think maybe even the bridge lenders are pulling back on terms in some cases, or it's becoming a little bit of a harder market towards the end of the year. What are you seeing out there with some of the debt funds or other bridge lenders?
Yeah, generally we really haven't seen much of a pullback for decent assets in good locations. the only time when we see that is when the story just doesn't make sense, right? If you buy a property that is stabilized and there is not really much of an upside that can be argued for. Some bridge lenders are a little bit more suspicious of ongoing rent growth, right? So if you buy it and you still have projections of 10, 15% rent growth to make that bridge loan work, then that's where bridge lenders are pulling back. So we certainly see where in the past it was at 80% virtually for all of the deals. Now we see that some of them are, from a debt deal perspective, are coming in more in that 75 mark, and 70% at stabilized value, just to be on the safe side. So they may not be as aggressive in their view of the sponsors pro forma as they were in the past. So that we certainly have seen, but the appetite itself to do bridge loans, I think, is still at record level, right?
Yeah, right.
Yeah, right, John. I mean, there is no limitation. You can really find financing for virtually any deal out there. It's really only a question of whether you can push the leverage all the way up.
Yeah, I think, our challenge sometimes, Mark, is we'll interact and advise, varying degrees of sophistication with regard to the buyers, and we're having to kind of sometimes educate them to understand, out in the market, just because you think you've got a debt quote, maybe it's a bridge quote, do they understand the moving parts, and does it pencil out on the back end to be able to hit their exit hurdles? And so it is a little bit tough sometimes to communicate that, but if we can get those leverage expectations baked right, it gives them a better line of sight of where the returns might really be.
Yeah. So I would say what we have seen is that obviously you always need an appraiser supporting your pro forma, right? And we have certainly seen some cases where the appraisers are not as bullish, and that then translates also into the underwriting by the bridge lenders. What we also have seen is that certainly depending on the market, there are wide ranges of debt deals, stabilized debt deals that they are accepting. Right, in some of the markets, we are in the 6% debt yield of stabilized NOI, whereas in some of the tougher markets, they still want to be in the upper sevens. So, and that is a challenge for buyers, right? So they look at what they are able to get for a perfect property in a perfect submarket, and they apply that same principle in their underwriting for another property that is in a lesser market, and they make that offer, and then they realize that even for a bridge, they may not get to that aggressive level.
Yeah, that makes a lot of sense.
Yeah.
What have you? Where are you looking? Where are you financing most of your deals in today's market? In the Metroplex at all? Or are you looking in secondary markets or Atlanta or other big active markets?
Yes, some of them are certainly in the Metroplex, but a lot of our clients have and you talked about the buyer fatigue, right? They have decided that it's just not worth their time to compete in a DFW market, so they have moved into others. I would say Houston is only the darling for a lot of people that were active and have a strong interest in DFW, but just felt that it's not going to work, right? And I think that's probably also a function of again, of the leverage that you're actually able to get, right? As you may know, for Fannie, Houston MSA is still a so-called preview. So you you do not get the high leverage on the agency side there to begin with. So that was a disadvantage there. But now with a stabilized property in DFW, you probably will end up at 65 to 70 max anyhow for an agency loan. So now the attraction is no longer really there to go into DFW when that leverage is not higher. And I think that's why a lot of people have picked up in Texas, have picked up Houston, as well as San Antonio. Naturally, all the other markets across the country, they're all on fire, right? I think a lot of buyers we see, they loved Atlanta, but when we look at the price increases in Atlanta, they were actually crazier than DFW. So a lot of buyers moved out of there too, right? So Florida, I think, is still, even though the prices are very high, the price increases have not been as severe as in Atlanta and DFW. Probably the worst what we have seen right now is Phoenix, the Phoenix MSA, right?
Yeah.
So you, I think you also have a property listed in El Paso right now, right? Or have it close onto the market. So how do you see it there in terms of price increases and how it will compete with a market like maybe San Antonio?
Yeah. I mean, I really like El Paso. We sold a property, 188 units there a little bit earlier this year. And I mean, when you look at the market, I don't know how many units are there, offhand. I'm going to say it's somewhere around 10,000 units. But, a good majority of the market is owned by just a couple of players. And there's still, I think the challenge in the past has been third-party management, going in there with kind of limited, third-party management. And it seems like it's opened up, a little bit over the past 2-3 years. We've seen some other, private syndication groups that, who we all probably know, go in there. And I think they've done really well. You've got 2.5 million people between El Paso and Juarez there, Ciudad de Juarez, as many call it. But anyways, huge trade and logistics hub, and it's been strong. I think, deals that were trading for 30s, 40s, 4 years ago, 2 years ago, they were up in the 50s and 60s. And now, those workforce housing deals are up in the 70s and 80s a door there. We traded the deal at 77,000 a unit roughly. And I think on a price per square foot, there were large units on a price per square foot a little bit lower, but had to be roughly around 80 cents or $80 a foot. But the cap rate on that was, when you looked at it from a tax adjusted basis, it was really no different than probably what you get in Dallas Fort Worth or Houston. There was a value add component to it, but I mean, the tax adjusted cap rate was down into the 3% range. I think the T3, T12 was right around 4.5%. So anyways, I mean, there are that was maybe a little bit different case, but there are deals trading there for, I think probably today it may be tough to find north of a 6 cap. I mean, they're definitely there in El Paso. But I'd say probably, it'd be in the higher mid to higher 5 range as cap rates have continued to compress across the country. But not as a lot of, not a ton of, buyer demand like you would see in some of the other major metros. But I think the fundamentals are really good when you look at kind of the vacancy and rent growth. Amazon adding 750 jobs at the end of this year with a new distribution center. So, continued job growth, although it's not a Dallas, Fort Worth, Houston, or Austin job growth. But I think the fundamentals are there.
Have you seen similar rent growth there too?
Yeah, I think they're lagging behind. I want to say the last I checked was somewhere sub 10, maybe 9%. So not like And honestly, I mean, I'm into the really focus in DFW. So that's
Sure, yeah.
where my focus is. I couldn't tell you what San Antonio rent growth is off the top of my head, or Houston, but I know they're north of 10%, or at least I think they're north of 10%. So being, El Paso, probably the 5th largest MSA in Texas, it probably lags a little bit behind on rent growth than some of the other major metros, but it's still strong.
Yeah. Yeah, very good. Thanks for all your insight. John, do you have any other comment or question that you want to bring up?
No, I'm good. I mean, thanks again for your time, Mark. It's been great and a pleasure visiting with you.
So really, thanks again, Mark. So how can our listeners reach you? Obviously, you're a well-known broker in DFW, so most people will know you, but there are always others that may not. So how can they reach you?
Yeah, best is probably through LinkedIn or email. I try to stay active on LinkedIn, posting content. So LinkedIn, my email is mark.allen@greystoneisg.com, which stands for Investment Sales Group. Our website is www.greystoneisg.com. And I don't know if this will air, but if you guys would love to have you there next week, we're having our multifamily forum, just be a half-day event. A lot of owners. We're going to have an owner panel, an equity panel, and Dr. Dotzauer will speak in the morning. I think he's the first speaker, so he'll speak about the current economy and his projections for the future. And if you haven't seen him, he's a really great speaker. He's humorous, so. Would love to have you both there if you can make it next Friday, and that's a free event. And
great, appreciate it. Again, congrats on all your success, and so you're certainly the person to know in DFW for anyone who wants to sell or buy a property. So all the best to you.
Thanks. No, thanks for having me on. And, same with you. It's been great to see, your trajectory coming off and starting peak financing, which is awesome. And would love to do another deal with you again soon.
Yeah, same here. Thanks, Mark.
Thanks, Mark.
Thanks, guys.